Payment in FX is absolutely different from leveraged FX. It's a requirement to convert from one currency to another for a purpose in a one-to-one conversion. Whereas leveraged Forex is to take on a live position or contract in the leveraged world to speculate in the market, where profits can be reaped if the entry is in favor of the trend, and losses do occur at a much faster rate depending on the leverage used. Suisse. We believed in educating and sharing knowledge to our clients. Forex is a neutral market, and nobody can control it. Prices always fluctuate, and price stability is out of the picture due to volatility experienced in every major fundamental events, such as interest rates, employment data, press conferences, and monetary policy. The worst would be central banks can manipulate the market via intervention steps to weaken their currency when the trend has been formed. And often, if business are not kept well informed of such information to make preventative measures in their exposures, they will bleed if they are caught on buying the currency when it's going to depreciate in times to come. As such, we have seen the Japanese yen, Aussie dollar, and Canadian dollar weakened more than 10% in 2013. And the next time they need to convert it back, they may experience severe losses despite any ROI gained in that country's investment. There is a bid and offer rate where seller will be looking at the bid to sell their base currency, and buyer will be looking at the offer to buy another currency. Pricing is not a transparent indicator in the payment world for FX, as the volume often do not match the minimum requirement required via the liquidity provider through interbank, which often explains why most clients cannot fetch a consistent price if they are exchanging in different amount from time to time. Therefore, volume is one of the essential elements in pricing. Smaller amount indefinitely will never get the closer cut to interbank pricing due to high variable costs involved in hidden and miscellaneous charges. Business also often neglect the simplicity of FX fluctuation in a given day. They could miss a better price if they need to buy a currency at the low of the day compared to the time they call in to deal when it's at the high of the day. As such, timing to the market is also another important component. The key reason why payment cannot fetch the interbank price is because most payment are a one-time off conversion, and its volume do not match the minimum requirement. As such, there are tiers to pricing. When the client decides to buy or sell in their expected pricing, the market has moved and they might get a poorer or better price depending on circumstances. RS Markets gives you a different perspective inside the market through our trader views. Our traders analyzed and shared the technical and fundamental insights in a neutral basis for both buyers and sellers. Clients can better understand the market through the daily commentary updates of what had happened previously and what other fundamental events that are moving the market, so they can be prepared and anticipate to participate in the event of a price fluctuation at key levels, maximizing the potential to maximize their profits and minimize the losses. Few weeks ago, you might get a better price to sell a currency but miss the opportunity. You might never fetch the deal again. Currency can also be more expensive to buy once technical indicators has suggested a breakout has happened, which might escalate the trend further, causing business to be affected in such juncture. Users can use our traders' insight to make critical decisions at any given time they need to buy or sell a currency. Through informed decisions, business can take control of their FX exposure by knowing their mean of currency exposure, which might have an adverse or positive impact on their P&L. Request to speak to our staff today, and we might be able to assist you in your currency exposure by monitoring your FX needs.